Well, I looked at the rest of the 38 stocks in the online ETF, like Revolve, Wayfair, Real, Lands End. They're all up this month 15 to 25%. They're all down 55 to 85% for the year. So what does that tell you? It tells you it's the group. I had this thesis that it was the return trade, right? That everybody went, oh my gosh, COVID's back. We're not going to get the return to work, the return to play, the return to do things trade. And so these stocks traded off. And then when I looked at all the rest of them, I said, nope, a lot of these guys aren't in that category, and their stock charts look very, very much the same.
Yeah.
Now, the ones that rebounded the most, however, are part of that return to doing things trade. And I think some of that, therefore, is probably overreaction on the COVID side. I mean, after all, the consumer's now looking at COVID and going, oh, that scary monster that used to be out there, it's now more like an annoying coyote in my yard. I don't want to pet it, but I also am not going to stay in the house because of it. So the consumer's out doing things, and when they do that, they buy things. So things like the Real or Etsy or any of those that work with that consumer. And remember, that consumer is younger and more affluent than the average consumer. So they're going to buy stuff and do things as long as they can. But I do think that what we're seeing here, I don't want to call it the dead cat bounce.
I was thinking that.
Yeah. I'm already down 85% bounce, right? Yeah. And so any reaction at all that's positive, and Goldman came out and they gave a positive rating to Rent the Runway, and then there were some insider buys. People watched that and they say, well, the guys that run them look like they're going to be playing the game, so maybe I should too. But boy, I remember the crash of 2000. I remember when Amazon was $8 a share. And there's a simple rule, and that's when interest rates are low, narratives rule. The company with the best story wins. When interest rates are rising and growth is slowing, value wins. Companies have to show what they're worth by generating profits and free cash flow, and that is not this group. And it wasn't that group in 2000 either.
Sure.
So do I think it's different this time? Yeah, probably not. Money's expensive, funding's drying up, valuations are greater. It's the same game we were playing in those days.
Let me ask you a broader story, Jan, because we have heard sort of two different things from the big companies reporting earnings on the consumer. On the one hand, they're saying, consumers are starting to have trouble paying their bills, especially the low-income households. On the other hand, we're hearing them say, actually, spending's holding up pretty well, or it's up 30% year on year. What do you think is the state of the U.S. consumer this summer?
I think if you're in the top three quintiles, top 60%, you're doing fine. And that's why people like Allbirds can say things like, the consumer's fine. And that's one of the ones that have bounced here. Or Etsy could say that. However, the bottom two quintiles, the bottom 40%, they don't look so good. So when you're talking to the off-price guys, when you're talking to the dollar stores, when you're talking to Walmart, they'll say, we're seeing some resistance from that consumer to price and inability to spend. And if you talk to the banks, they'll tell you they're seeing problems with credit, but not the kind of problems we've seen in the past with credit. So yeah, we're seeing some breaks in the system, but so far the consumer seems really, really healthy, and they're still sitting on a lot of cash. And right now, they still all have a job, and they're still out there spending, because I'm telling you, they have decided, I'm going to go do stuff, and I'm going to buy stuff to take with me when I'm going places.
And I guess
they're still doing that.
Last question then, because we know that the labor market is still very strong. Wage income, especially non-supervisory income, very, very strong. We're talking 6 to 7%. So who would you bet on for the back half of the year? What you're describing sounds like stay away from low income, bet on high income, but what if wage momentum proves stronger than expected?
Well, if wage momentum proves stronger and we're not really going to have even a technical recession, and we're not going to get any increases, that 3.6% is not going to go to 4% unemployment, or we used to think it was going to go down to 3.2% unemployment, remember? And we thought we'd have 7% growth in wages. So depending on what happens there, you'll be right or wrong on who you should bet on. But I'm betting on luxury stocks. And I think that near luxury stocks like Capri and Tapestry and Levi and those kind of people are going to do well. And I think LVMH and Gucci Kering are going to do really well. So I'm betting on that upper 60%, not the bottom group. But certainly, I wouldn't bet against Target. They deal with a fairly affluent consumer, and they've gotten hammered. their consumer is going to be there.
Yeah.
I'm a big Walmart fan, but their consumer is struggling a little bit, but they execute better than anybody else. So when you're looking at that, it's not these companies we're talking about as far as direct to consumer. It's the big players that have been strong and reinvested in the business. It's the Costco's of the world.
Yep.
They're going to have pretty good numbers unless something really happens to the consumer here that I don't see so far.
All right. Jan, good to check in with you. We'll leave it there for now. Thanks.